Hi everyone, my name is Catherine Hugh, and today I will be discussing the Pfizer Incorporated stock in depth. I have pulled information from the Bloomberg terminals, MarketWatch, Yahoo Finance, ValueLine, and more to financially analyze this stock. First, let's take a look at Pfizer's company history. Founded in 1849 by two German immigrant scientists named Charles Pfizer and Charles Erhardt, Pfizer was established in Brooklyn, New York. As a research-based pharmaceutical company, Pfizer generates medicine for cardiovascular health, metabolism, and oncology. It is an S&P 500 company and has established itself as a multinational corporation. In 2004, Pfizer joined the UN Global Impact and was selected to be included in the Dow Jones Industrial Average. Its corporate headquarters are located in New York, and its research headquarters are located in Connecticut. The company strives to make breakthroughs by changing patients' lives. Now let's talk about Pfizer's industry and competitors. Pfizer is categorized by the S&P 500 under the healthcare sector. The healthcare sector is known to be one of the largest and most complex sectors in the United States economy, and it is composed of businesses that create medical equipment or drugs, provide healthcare services, or are otherwise involved in healthcare. Pfizer is in the pharmaceutical industry, which is also known as the drug manufacturing or biotechnology industry. In this industry, Pfizer's major competitors include Johnson & Johnson, Merck & Company Incorporated, Eli Lilly and Company, and Novartis. All listed competitors are ranked as the top 10 pharmaceutical companies in the United States. Moving on, let's discuss Pfizer's 2018 annual report. The annual report is a report generated yearly regarding the activities and financial performance of a firm. It is sent to shareholders and other individuals interested in the company's yearly status. In Pfizer's annual report, we can find the letter to shareholders. In this letter, shareholders are notified that Pfizer's R&D pipeline is the best in Pfizer history. R&D refers to research and development and is crucial for the success of pharmaceutical firms. Shareholders are also told that revenues increased 2% as a result of the growth of Ibrance and other big-selling medicines and vaccines. The firm took a $1.7 billion loss as a result of losing market exclusivity for some of its products. Market exclusivity loss occurs when a product's patent expires, thus allowing generic brands to copy products and take a high percent of the market. Pfizer reports that growth in emerging markets and biosimilars have helped absorb those losses. Pfizer also invested around $8 billion in R&D and returned $20.2 billion to shareholders through dividends and share repurchases. In 2018, Pfizer's share price increased by around 21% and outperformed the New York Stock Exchange Pharmaceutical Index as well as the S&P 500. Lastly, the company announces reorganization into three main segments: innovative medicines, established medicines, and consumer healthcare for the future and sustainable growth of the business. Taking a look at the financial analyst statements and recommendations, we can see that from July 29th to November 4th in 2019, the most popular recommendation was hold. Hold means analysts recommend that investors neither buy nor sell the stock. Looking at these recommendations, we can see that the general consensus suggests that Pfizer is performing at an average pace or slightly better. Some current news and articles written about Pfizer include the announcement of the FDA's approval of Pfizer's biosimilar, which is a minor variation of an already approved drug, Pfizer's expensive Vyndaqel medication, and Pfizer's solution to a recent drug shortage as the sole supplier. Now let's take a look at a snapshot of Pfizer's stock price for the past 5 years in comparison to its major competitors. The chart is normalized so that we can compare the growth rates over time. For the most part, Pfizer has done relatively well in comparison to its competitors, and its stock price performance has been above average. Near the end of November in 2018, we see that Pfizer has realized the second highest growth rates, only behind Eli Lilly. However, since July 2019, Pfizer has taken a hit, and now its performance is below average. In this slide, we will examine Pfizer's legal insider trading, where corporate insiders trade firm securities only utilizing public information. The most recent activity shown here includes buys from Angela Huang and Scott Gottlieb in August of 2019. However, there have also been many sales within the past year. Next, let's take a look at top management and compensation. Here we can find Pfizer's 13 executive leaders. Recently, there have been some changes made to the top management team. As of January 1st, 2019, Ian Read stepped down from his former position as CEO, while retaining his executive chairman of the board position. Albert Bourla, who was originally the chief operating officer, is now the chief executive officer. Ian Read also announced that he will be retiring from his position as executive chairman of the board as of December 31st, 2019. CEO Albert Bourla will then take his place. According to information gathered from Bloomberg, executive chairman of the board Ian C. Read earns $19,549,213, while chief executive officer Albert Bourla earns $9,854,557. Next, let's take a look at PE ratios, dividend yields, bond ratings, and betas for Pfizer and its competitors. In the PE ratio column, it is evident that Pfizer's ratio is a little bit higher than the competitor average. PE ratio, which stands for price to earnings ratio, can show whether a stock is overvalued or undervalued. In this case, Pfizer's stock is slightly overvalued in comparison to its competitors. Dividend yield, as shown in the following column, is defined as the ratio between a company's annual dividend and their share price. This value estimates the average annual return of a stock, based solely on the dividend payment. Pfizer's dividend yield is higher than its competitors, as well as the S&P 500 healthcare average. This makes Pfizer's stock an attractive investment since it generates higher returns in terms of dividends. In the bond ratings column, credit rating companies provide their objective evaluation of firms and their stocks. Overall, Johnson & Johnson has the highest rating. All credit rating agencies have identified Pfizer as a relatively high-quality stock to invest in. However, it is more susceptible to economic changes and circumstances, and thus has a relatively lower rating compared to Johnson & Johnson. The beta column shows investors' stock risk and volatility in comparison to the market, where the market beta value is always 1. Riskier stocks receive a beta value above 1, while lower risk stocks receive a beta value under 1. Higher beta usually denotes higher return, while lower beta is correlated with lower return. In the table here shown, we see that Pfizer's beta is 0.989. This means that Pfizer's stock has a higher risk, as well as a higher potential return relative to most of its competitors. Taking a look at ROE, or return on equity, we can see how many dollars of profit the company makes based on each dollar of shareholders' equity. An increasing ROE implies that a company is increasing its profits without needing as much capital. Thus, higher ROE is favorable, and falling ROE is unfavorable. According to MarketWatch, Pfizer's ROE was slightly under the sector average. Next, let's discuss Pfizer's capital structure, which will break down the type of funding Pfizer receives and uses to finance its activities. In the past year or so, Pfizer has increased its long-term debt, which has thus increased its debt-to-equity ratio. However, this should not pose an issue for the company as it has yet to face liquidity issues. Moving on to EPS, DPS, and BVPS, we can compare Pfizer's growth rates to that of its competitors. EPS, or earnings per share, shows a company's profitability. Usually, high EPS equates high profitability. As seen in the table here, Pfizer's 2019 and 2020 predicted EPS rates are in the negatives, which means Pfizer will be losing rather than gaining money. Depicted in the next column is DPS growth rates over time. DPS, which is also known as dividends per share, is the total amount of dividends a company pays. This value can show a company's financial health and stability, since financially stable firms will be willing to and able to pay dividends. Pfizer's DPS predictions for 2019 and 2020 are relatively low compared to its competitors. and this is not really a good sign. Finally, in the BVPS column, we can find book value per share. Book value per share is a method used to calculate stockholder equity to the number of shares outstanding, and it represents the asset value per share a company has. In 2019, Pfizer's BVPS is predicted to be negative overall. However, the 2020 prediction is that Pfizer's BVPS will increase to 8%. This means that Pfizer will acquire more assets to increase the company's efficiency and productivity. These assets may also relate to Pfizer's plan to produce more medication in the future. As a growing and evolving business, Pfizer has engaged in many merger agreements in the past. Some of the most notable agreements are listed here. These mergers have allowed Pfizer to expand its network, knowledge, and fields of medicine to best achieve its mission. Pfizer has also acquired many companies as seen here. Pfizer is also currently partnering with Milan, a generic pharmaceutical company, to conduct a merger between Upjohn, which was a part of Pfizer, and Milan. This is predicted to occur in mid-2020. Agreements say that Milan will take 43% of the combined company, while Pfizer will take the remaining 57%. Some current events that have impacted Pfizer include patent cliff. Patent cliff refers to when product patents expire and companies face abrupt sales drops. In 2019, both Lyrica and Viagra's patents expired, resulting in a loss for Pfizer as generic drug makers increased market share. Additionally, as previously mentioned, Pfizer will also be conducting a merger in the year 2020. This will allow Pfizer to focus more on creating brand drugs and less on creating generic drugs, as Pfizer will spin off Upjohn, its business that focused more on generics. This merger will also establish Pfizer as a smaller business base and allow it to focus more on research and development. This will most likely have a few effects on Pfizer. First, Pfizer's earnings will go down as Upjohn generated about 22 to 28% of Pfizer's total revenue. However, this should be made up by the new shares from the new company and its respective earnings. Second, Pfizer expects stronger earnings growth as Pfizer can concentrate more on its brand drugs with the spin-off completed. This spin-off will also likely result in a smaller dividend pay. Beyond Pfizer's current events, there are also political and global risks that may impact Pfizer. One such risk is the potential changes for the Grassley-Wyden drug bill. This bill aims to lower the cost of prescription drugs for the public. Pharmaceutical journalist for the Wall Street Journal, Peter Loftus, says that the bill would peg drug prices in the U.S. to prices paid overseas, and if a drug's price increases by more than that of inflation, companies would have to pay rebates. While this bill has yet to be voted on by the House floor, the potential passing of this bill may detrimentally impact pharmaceutical firms, including Pfizer. As for my own recommendation in regards to investing in Pfizer stock, I would recommend investors to hold. This is because while Pfizer has been a strong contender in its industry, its recent performance has proven to be slightly below average, as we've discussed throughout this presentation. Additionally, I would recommend investors to hold because of the uncertainty regarding Pfizer's future growth and company outlook. With upcoming updates on the drug bill and Pfizer's merger with Milan, I think it would be safest to wait until 2020 to decide whether or not to invest in Pfizer. By then, the spin-off will be completed, and the results from Pfizer's smaller but more concentrated company will be released. Those two pieces of information are vital for the future of Pfizer, and thus it would be the safest option to hold Pfizer stock right now. Thank you for listening to my Pfizer Stock Analysis presentation. I hope you enjoyed!